Okay, get this. What if I told you that there's this really strange puzzle right at the heart of the stock market? A puzzle where millions of people can be right about which stocks are going to go up and still end up losing money? It's a real thing. It's called the retail investor paradox, and it's all about everyday investors. People like you and me, anyone trading from their phone or laptop.
For years, this question has been debated by all the experts. Are these everyday investors some kind of market wizards, secretly seeing the future? Or are they just gambling, getting lucky, or more often, unlucky? Well, a really fascinating study by researchers Barber, Lin, and Odin dug into all the data, and you know what they found? The answer is kind of both. And that, right there, is where this whole mystery really begins.
And here is the paradox in black and white. On one hand, you've got this incredible fact. When you look at all the stocks retail investors buy, as a group, those stocks actually tend to do pretty well in the short term. I mean, that sounds like a win, right? But then, on the other hand, the data is just as clear. The average retail investor consistently loses money from trading. So, how? How is that even possible? How can a whole group of people be collectively right about their stock picks, but then individually they lose money? It seems like it can't be true, but it is. So let's dive into the research and solve this thing clue by clue.
All right, first up, let's just make sure we're all on the same page with the paradox itself. This isn't just some fun little riddle. It's based on real, conflicting evidence that has genuinely stumped financial researchers for a long time.
So, where do we even start looking for the answer? Well, the first big clue isn't about what stocks people are buying, but how we measure whether they're winning or losing. It turns out, the way you weigh the wins, it changes everything.
Okay, so let's start with what you might call the academic way of looking at it. It's called an equal-weighted strategy. Just imagine a totally hypothetical world where you invest the exact same amount of cash, let's say $1,000, into every single stock someone buys. This approach is all about measuring the performance of their average stock pick.
So the researchers give us a super simple example to show how this works. Let's say an investor buys 3 stocks. 2 of them go up by 1%, 1 goes down by 1%. Now, if they invested an equal $1,000 in each one, they'd actually come out ahead by $10. So their average stock pick was profitable. This explains that first part of our paradox. On average, their picks are actually pretty solid.
But that's not what really happens in the real world, is it? We don't put the exact same amount into every single stock. And that brings us to the trade-weighted strategy. This looks at how much money investors actually put on the line for each stock. This measures the performance of their average dollar invested.
And boom, here it is, the big aha moment. Using the exact same stocks, let's look at how the money was really invested. They put $1,000 into each of the 2 winners, but they bet big, $3,000 on the loser. And just like that, a $10 profit flips to a $10 loss. They were right more often than they were wrong, but they put their biggest bet on the one stock they got wrong.
Okay, so that explains how they lose money. But it just opens up a much bigger question. Why? Why on earth would investors put their biggest bets on the stocks that are most likely to fail? The answer, our next big clue, is all about the power of attention.
So, the researchers found that retail investors are often driven by something they call attention-induced buying. Think about the stocks that get all the headlines, the ones blowing up on social media, the ones with these insane price swings. These are the loud stocks. They grab our attention, and when we're looking for something to buy, they're the first thing we see.
And the amount of money flowing into these stocks is just staggering. Look at this number. According to the study, 42.6% of all the money retail investors put into the market is concentrated in just that tiny group of stocks they're buying most aggressively. Almost half their firepower is aimed at this very narrow list of loud stocks.
And here's the absolute kicker. This is where it all goes sideways. The research found that the stocks that have both heavy retail buying and this crazy frenzy of trading activity, these super high attention stocks, are the very ones that consistently perform the worst.
So let's put all these clues together now and look at the cold, hard numbers. This is where the study really shows us, without a doubt, why the crowd, even with some pretty good instincts, ultimately loses money.
This table from the research basically says it all. The equal-weighted strategy, remember, that's the average stock pick, is positive. That's a win. But just look at what happens when you weigh everything by the actual dollars invested. The returns completely flip negative. The very same set of trades goes from a win in theory to a loss in the real world, all because of where the big money was placed.
And there you have it, the solution to the paradox straight from the researchers themselves. The concentration of trading in the stocks that subsequently underperform means that on average, retail investors lose from trade. It's not that all their picks are bad, it's that their biggest, most confident bets are placed on the absolute worst stocks.
So, what does this all mean for different kinds of investors? In the last part of their analysis, the researchers took a look at who is most likely to fall into this attention-driven trap.
So to figure this out, they used trade size as a sort of stand-in, a proxy for how experienced an investor is. The thinking goes that wealthier, maybe more sophisticated investors tend to make larger trades, while less experienced folks make smaller ones. And what they found was a really clear and honestly a pretty concerning pattern.
This chart just lays it all out there. Look at the performance based on the size of the trade. The smallest trades, under $500, lost an average of 16.8 basis points in a single day. But as the trade size gets bigger, the losses shrink a lot. The largest trades, over 100 grand, lost practically nothing. The less sophisticated traders are the ones getting hit the hardest.
And the researchers explain exactly why that chart looks the way it does. They confirm that, quote, small purchases are more highly concentrated in attention-grabbing stocks, and small trades perform worse than large trades. Basically, the smaller investors are more easily swayed by the hype, and their portfolios are the ones that pay the price. So let's just do a quick recap of everything we've uncovered. This big retail investor paradox, it's not solved by magic, but by math. It all comes down to how you weigh the results. Everyday investors lose money because their big, exciting bets on those loud stocks go south, and those losses completely wipe out all the small wins they get everywhere else. And sadly, it looks like it's the smaller, less experienced investors who are most likely to fall for it.
And that really brings us to the final and maybe the most important question. This research isn't just a bunch of abstract numbers. It's about real decisions that we all make with our own money. So the next time you're about to make a trade, just ask yourself one simple question. Am I following the evidence here, or am I just following the hype?